Mr. Lankford.
Chairman, thank you for being here very much, and I also appreciate your open communication that you've started. More press conferences, more communication. Anytime you get the Federal Reserve ideas and thoughts out there, it's obviously helpful, and I know that's part of your strategy as well. So I appreciate you taking that on, allowing some more sunshine into your thoughts and the plans here. You mentioned earlier about small business access to capital, and that is a concern, and that's something we actually talked about last time that you were here. And the fact that you'd mentioned bank examiners are becoming more conservative in this time of instability, and that is an issue. I can tell you in community banks that I deal with, and I represent Oklahoma, community bankers are still very concerned with the, let's say, the approach on compliance. Safety and soundness they have no issue with. Compliance becomes a big issue, and especially with the number of rules that are coming down now and the number of regulations. Let me just give you one example. The new Volcker rule that was intended to only affect big banks, our community banks have to prove that they're exempt from it. And so you've got a bank of 40 people, total employees, going through pages and pages and pages of documents to prove they don't apply to this. It's adding a tremendous amount of workload that is not into lending, and that is forcing them to second guess. When we talked about this last year, you said there's been some modest improvements on that. I'd like to follow up and say, what improvements can we still expect in the coming days? Because the community bankers that I talk to still are not actively lending and are still second guessing every bit of risk, not sure if someone's going to come in and second guess them.
So I won't go into the safety and soundness part because your question was about compliance.
Right.
So it is certainly true that many of the provisions of dodd-frank are aimed at the biggest banks, and the
right.
small banks, it's irrelevant to them. And I agree with you that they should be spared even the need to demonstrate to their small banks. We know they're small banks.
But they currently do have to demonstrate it.
So what we're doing at the Fed, we have a subcommittee of two governors, Governor Duke, who was a community banker, and Governor Raskin, who was besides being a Senate staff person, was also the head of supervision in Maryland. So they're both very knowledgeable about small banks. And their job, working with staff, is to try to first make sure that rules that don't apply to small banks are not put in force, and that in addition to that, that we provide as much clarity as we can to what the small banks need to worry about and what part they can just throw away. To help us on that, we have created an advisory council of community depository institutions that we meet with and get their feedback. I appreciate your point, and I think it's progress that we're moving away from the safety and soundness issue, but we are working on that.
Do you feel like it's getting better in the next year? Because my community bankers that I'm talking to are getting more frustrated, and to them it's death by 1,000 paper cuts.
Right.
It's not any one single piece. It's just the frequency of how many small pieces are coming at them. And with the bank, again, 35, 40 people in total employees, they cannot keep up with the frequency of things that are coming.
We've already begun a process whereby we will try to provide instructions, guidance to smaller banks about what part they can just throw away without looking at it.
Okay. That'd be very helpful to continue to press on that. And I know you're attentive. Obviously, that's the highest number of banks that we have out there, not the highest systemic risk, but they're getting the brunt of a lot of this. Sure. Separate question for you, and it's a broader issue that I personally struggle with in trying to watch across the world. We have so much sovereign debt worldwide, and we're continuing to add more and more sovereign debt worldwide. At what point do we reach the definition of unsustainable worldwide, that we reach some kind of limit where we don't have enough liquid capital sitting out there for all the borrowing that's happening in all the sovereigns, not just us. Obviously, we're the largest of that. But there has to be some point that would be defined as unsustainable. There's not enough liquid capital to manage this, and we are pulling it out of the markets, and we've hit that cycle.
Well, at the moment, private borrowing is way down because of the weakness of the economy. So there's money out there. As we get to full employment, then you're going to start seeing the crowding out, that people are going to have to pay higher rates, and that's going to have the adverse effects I discussed on capital formation and productivity. I do think, though, that from our perspective in the United States, I think we are the premier economy. We are the safe haven. We have a strong interest in maintaining that status. So I guess I'd worry less about the global supply of capital and just really think about managing our own need for capital going forward.
Sure, I understand that, but there's a limited amount of liquid capital at any moment worldwide, and every country is competing for it at a higher rate
Well, so
It's accelerating.
there's a supply and demand, so interest rates will go up until supply equals demand, but so the money will be there in some sense, but if the rate is so high, that'll be bad both for the fiscal borrowers and for the private sector.
But that would be the definition of unsustainable, that we suddenly cannot get the money at the rate that we need it for in other countries, and obviously that affects us. And
That's right.
The contagion begins. The sense is, are we even close to that kind of point? I mean, that's predicting, that's crystal ball type stuff, but you've got to be watching that as well.
Well, again, for countries like the United States and the UK and others, rates remain very low, government bond rates. The bond market is very forward-looking. I mean, a lot of the bonds are 30 years, right? So a lot of this depends on what the bond markets expect the sovereign financing needs to be over the next few decades. And so once again, it's really, to some extent, a country-by-country issue. If we can take a strong set of policies to ensure the sustainability of our fiscal situation, I'm sure that the funding for the United States will be there.
Thank you. You're back.
Queue is closed. Last question.